$2 trillion. That is how much the world will spend on artificial intelligence in 2026, according to Gartner. $2 trillion. And here's the statistic that should make every investor sit up straight. A study from MIT found that 95% of enterprise AI projects are delivering zero financial return on investment. We are spending $2 trillion on something that for the vast majority of companies is not making any money. So either we are on the verge of the greatest productivity revolution in human history, or we are building the most expensive bubble since the dot-com crash. I'm Alex.
And I'm Maya. Welcome back to Asia Tech Macro. Okay, Alex, that is a genuinely scary opening. $2 trillion in spending and 95% zero ROI. But before we go full bear mode, there are some incredible things happening in AI right now. So help me understand, is this a bubble or a boom?
That is the $2 trillion question. And I think the answer is, it is both, simultaneously, depending on where you look. Let me start with the boom side, because the numbers are genuinely historic. The Stargate project, announced in January 2025, has become the largest infrastructure investment in tech history. SoftBank, OpenAI, and Oracle committed to invest $500 billion over 4 years in AI data centers across the United States. The initial deployment was $100 billion.
$500 billion. That is not a typo? 500 billion?
Not a typo. And it is accelerating. As of early 2026, Stargate has announced 5 new U.S. data center sites beyond the flagship facility in Abilene, Texas. The combined planned capacity is nearly 7 gigawatts. To put that in perspective, 7 gigawatts is roughly equivalent to the power consumption of a country like Denmark. They are building a Denmark-sized power grid just for AI data centers.
And SoftBank is at the center of this, which brings us to Masayoshi Son. He has been making some extraordinary moves.
Son has essentially bet his entire company on AI. In late 2025, SoftBank dumped its entire $5.8 billion stake in Nvidia to free up capital for a $30 billion follow-on investment in OpenAI. Think about that. He sold Nvidia, the single best-performing AI stock, to buy equity in a private company that is burning cash. That is either visionary or insane.
Or both, which is kind of Masayoshi Son's brand at this point.
Ha, fair point. But there is method to the madness. Son launched what he calls Project Izanagi, named after the Japanese creation god. It is a $100 billion venture to build a vertically integrated AI chip company that could rival Nvidia. By combining ARM, which SoftBank owns 90% of, with acquired companies like GraphCore and Ampere Computing, SoftBank has created what it calls a unified AI computing segment. The goal is to ship the first batch of competitive AI chips by mid-2026.
Wait, SoftBank is trying to build a competitor to Nvidia? That seems incredibly ambitious given Nvidia's lead.
It is incredibly ambitious, but Son's logic is that the current AI infrastructure stack is too dependent on a single company. Nvidia controls about 80% of the AI training chip market. Every hyperscaler, every startup, every government AI program depends on Nvidia GPUs. Son sees that concentration as both a vulnerability for the industry and an opportunity for a challenger. If ARM-based AI chips can capture even 10 to 15% of the market, that's a $100 billion annual revenue opportunity.
And the revenue numbers for the AI labs themselves are staggering. What is OpenAI targeting?
OpenAI is targeting $30 billion in revenue for 2026, roughly double its 2025 figure. Anthropic is aiming for $15 billion, and according to Epoch AI, Anthropic could actually surpass OpenAI in annualized revenue by mid-2026 on certain trajectories. The interesting Asia angle is that 3 of Anthropic's top 5 global markets by usage are in Asia: Korea, Japan, and India. Anthropic is opening an office in Gangnam, Seoul in early 2026 and tripling its international workforce to meet demand.
And I have to point out, the competitive dynamics between OpenAI and Anthropic are fascinating. OpenAI just closed a $40 billion funding round led by SoftBank, the largest private check funding in history. Anthropic is valued at around $60 billion. These are private companies generating tens of billions in revenue that didn't exist 3 years ago. The speed of value creation is unprecedented.
It is unprecedented. And in February 2026, SoftBank shares surged as Masayoshi Son unveiled the full scope of the Izanagi era. He has repositioned ARM from a simple architecture licensor into a direct provider of high-performance AI chips for data centers. The company now has a unified AI computing segment that includes ARM, GraphCore, and Ampere Computing. Son's goal is to ship competitive AI chips by mid-2026. If ARM-based AI chips can capture even 10 to 15% of the market, that's a $100 billion opportunity.
But let me bring this back to the core question. With all of this incredible growth, all of these eye-popping numbers, is there actually a bubble forming? Because the spending levels are making even the optimists nervous.
That is exactly where we need to go next. The boom side is real, but the bubble side is equally real, and the two are happening simultaneously, which is what makes this moment so confusing for investors. The bubble argument starts with a simple math problem that nobody in the industry wants to talk about openly. Global AI spending is $2 trillion in 2026, but actual AI revenue, the money that AI companies are collecting from customers, is roughly $100 to $150 billion. That means for every dollar of AI revenue, approximately $15 to $20 are being spent on infrastructure, chips, data centers, and talent. That ratio is unsustainable unless revenues grow dramatically and fast.
So we need AI revenues to go from $150 billion to something like $2 trillion just to justify current spending levels.
Exactly. And that has to happen within about 4 to 5 years for the investments to make economic sense. Goldman Sachs CEO David Solomon said he expects a lot of capital that was deployed that does not deliver returns. Jeff Bezos called the current environment kind of an industrial bubble. And here's the most telling quote of all. Sam Altman himself, the CEO of OpenAI, the company at the center of the AI boom, warned that people will overinvest and lose money. When the person leading the revolution tells you to be careful, that is worth listening to.
Those are remarkable warnings from the people closest to the action. But let me play devil's advocate. The same things were said about cloud computing in 2010. Amazon Web Services was losing money, Google Cloud was an afterthought, and many analysts said the cloud spending was unsustainable. But cloud became a $200 billion annual revenue business. Could AI follow the same trajectory?
That is the bull case, and it is a legitimate argument. The difference, and this is important, is that cloud computing had a very clear value proposition from day one. Companies could replace expensive on-premise servers with flexible pay-as-you-go cloud services. The ROI was measurable and immediate. You could calculate exactly how much you saved by moving your email servers to AWS. AI does not have that clarity yet. A National Bureau of Economic Research study from February 2026 found that while 90% of firms reported no measurable impact of AI on workplace productivity, executives still projected AI would increase productivity by 1.4% and output by 0.8%. So companies believe AI will help, but they cannot prove it yet.
That is the critical gap. The belief is there, but the proof is not.
And that belief-proof gap is where bubbles live. In every historical bubble, from tulips to .com to crypto, there was a period where prices were driven by belief in future value rather than demonstrated current value. The question is whether AI crosses the belief-to-proof bridge before the money runs out.
Let's talk about the Asia dimension specifically, because I think the dynamics are different here. Asia-Pacific is the fastest-growing region for AI agent adoption, with compound annual growth rates exceeding 50%. Singapore, India, Korea, and Australia are leading in financial services, telecom, and public sector AI. What is driving that?
Several factors. First, many Asian economies have severe labor shortages, especially Japan and Korea, which makes AI automation not a luxury but a necessity. Second, Asian governments are more interventionist. Singapore's government has made AI adoption a national priority with direct subsidies. Japan's Takaichi government has earmarked massive spending for AI. India hosted the AI Impact Summit with $277 billion in investment commitments. Third, and this is underappreciated, Asian consumers are more willing to interact with AI than Western consumers. Chatbot adoption rates, AI assistant usage, and comfort with automated services are all higher in Asia.
And the competitive landscape in Asia is different too. In the US, it is basically OpenAI versus Anthropic versus Google, but in Asia, you have local champions. In China, you have DeepSeek, Alibaba's Qwen, Baidu's Ernie. In Korea, you have Naver and Kakao developing their own models. In Japan, NTT and NEC are building enterprise AI platforms. This is not a winner-take-all market in Asia the way it might be in the US.
That fragmentation is actually both an opportunity and a risk. The opportunity is that multiple AI ecosystems can coexist, creating a richer innovation landscape. The risk is that fragmentation prevents any single platform from achieving the scale needed to justify the enormous infrastructure investments. If the market splits into 6 or 7 regional AI ecosystems instead of consolidating into 2 or 3 global platforms, the unit economics become much harder. Contrarian corner time, Maya. And today, my contrarian take is going to upset both the AI bulls and the AI bears. Here it is. The AI bubble will not pop. It will deflate slowly, and the deflation will be invisible to most investors because it will happen through margin compression, not revenue collapse.
That is interesting. You are saying this is not going to be a dot-com style crash?
No, and here's why. The dot-com bubble popped because the companies were built on vapor. Pets.com, Webvan, eToys, they had no revenue, no product market fit, no viable business model. When sentiment turned, there was nothing underneath. AI is fundamentally different. OpenAI has $30 billion in revenue. Anthropic has $15 billion. These are real products being used by real companies. The technology works. It is not vaporware.
So what is the problem then?
The problem is not that AI does not work. The problem is that AI does not work well enough, fast enough, to justify the current level of spending. Let me give you a concrete example. A major consulting firm recently estimated that the average large enterprise is spending about $20 million annually on AI initiatives. Of that $20 million, roughly $15 million goes to infrastructure, cloud compute, and data engineering. Maybe $3 million goes to the actual AI models and tools, and the remaining $2 million goes to talent and consulting. The measurable productivity gains from those AI initiatives? About 5 to 8% improvement in targeted workflows. That translates to maybe $2 to $3 million in savings or new revenue. So the ROI is negative. Companies are spending $20 million to get $3 million in value.
But they keep spending because they are afraid of falling behind.
Exactly. It's the keeping up with the Joneses effect at corporate scale. No CEO wants to be the one who did not invest in AI and then watched competitors pull ahead. So the spending continues even when the ROI is negative, funded by the fear of missing out rather than by demonstrated returns. This is what I mean by invisible deflation. Revenue will keep growing because companies will keep buying AI tools out of fear. But the margins for AI companies will compress because competition is intensifying. OpenAI, Anthropic, Google, Meta, Microsoft, Amazon, every major tech company is competing for the same enterprise customers. And open source models from Meta's Llama and China's DeepSeek are creating a pricing floor that gets lower every quarter.
So the deflation happens in profitability, not in top-line revenue.
Precisely. AI revenues will likely hit $200 billion by 2027, but the margin on that revenue will be much lower than investors expect because the cost of compute is enormous, competition is brutal, and open source alternatives put a ceiling on pricing power. The companies that survive will be the ones that can achieve scale while maintaining margins. And in my view, only 2 or 3 companies globally will manage that. Everyone else, including most of the AI startups and even some of the Western ones, will face a slow squeeze.
And what does this mean for Masayoshi Son and Project Izanagi? Because SoftBank's entire strategy is premised on the idea that AI infrastructure investment has massive returns.
This is where it gets really interesting. Son's bet is different from most AI investors because he's investing in the infrastructure layer, not the application layer. He's building the picks and shovels, not the gold mine. Stargate data centers, ARM-based AI chips, energy infrastructure. In a gold rush, the picks and shovel sellers make money regardless of whether individual miners strike gold. If AI adoption continues, even with negative ROI for most enterprises, SoftBank's infrastructure still gets utilized.
Unless the gold rush itself slows down. If enterprises pull back on AI spending because they can't justify the ROI, the data centers sit empty and the chips do not sell.
That is the tail risk, and it's the same risk that destroyed SoftBank's Vision Fund in 2022 when many of its portfolio companies collapsed. Son has a pattern of making enormous concentrated bets that are either spectacularly right or spectacularly wrong. The Vision Fund lost about $32 billion before recovering. Project Izanagi is an even bigger bet. If AI spending growth decelerates from 50% annual growth to 20% by 2028, SoftBank's infrastructure is dramatically overbuilt, and overbuilt infrastructure with fixed costs is a recipe for massive losses.
So the historical parallel is not .com. It's the telecom fiber-optic bubble of 2000, where companies laid enormous amounts of fiber that took a decade to fill with actual traffic.
That is exactly the parallel I was going to use. The fiber was not useless. It eventually got used, but the companies that built it mostly went bankrupt before the traffic arrived. The question for AI in 2026 is whether we are in 1998 with the best year still ahead, or in 2000, right at the peak before the hangover begins. I think we are somewhere in 1999. There is still upside, but the margin of safety is shrinking rapidly. All right, Maya, let's close with 3 action items.
Action item number 1?
Number 1, separate AI infrastructure plays from AI application plays in your portfolio. This distinction is critical. Infrastructure companies, Nvidia, TSMC, ARM, the hyperscalers building data centers, they make money regardless of which AI application wins. Their revenue is driven by the total spending on AI, not by any single application success. Application companies, the startups building AI chatbots, copilots, and enterprise tools, face intense competition and rapidly compressing margins. If you believe in the long-term AI thesis but are worried about the bubble, overweight infrastructure and underweight applications. Nvidia and TSMC are the clearest infrastructure winners. ARM is a higher risk, higher reward play through SoftBank's Izanagi strategy. On the application side, only OpenAI and Anthropic have the scale and margins to survive long-term. Most other AI application companies will either be acquired or fail.
Infrastructure over applications. That is a clear framework. Number 2?
Number 2, watch the Asian AI adoption curve as a leading indicator. 86% of enterprises globally say their AI budget will increase in 2026. But the question is whether that budget increase translates into measurable ROI by the end of the year. Asia-Pacific is the fastest growing region, with CAGRs exceeding 50%. If Asian enterprises, particularly in Japan, Korea, and Singapore, start reporting positive AI ROI at scale, it validates the entire global AI investment thesis. Conversely, if Asian enterprises, which are adopting AI aggressively, cannot demonstrate returns by late 2026, that is a canary in the coal mine for the whole sector. Japan is a particularly important test case because its severe labor shortage creates the clearest use case for AI automation. If AI cannot demonstrate ROI in a market with a desperate labor shortage, where can it?
Japan as the AI ROI test case. I had not thought of it that way, but it makes perfect sense. The labor shortage creates the ideal conditions for AI to prove itself. And number 3?
Number 3, do not ignore the AI spending to revenue ratio. Right now, the global AI ecosystem is spending roughly $15 to $20 for every $1 of AI revenue generated. Track this ratio quarterly. In 2025, it was about 20 to 1. If it improves to 10 to 1 by end of 2026, the investment thesis is intact and spending growth is justified. If it stays at 15 to 20 to 1, we are in bubble territory and a correction is coming. The ratio will show up first in the earnings reports of cloud companies, specifically Microsoft Azure, Amazon AWS, and Google Cloud. Watch their AI-specific revenue disclosures very carefully. If cloud AI revenue growth decelerates while CapEx continues to accelerate, the ratio is worsening, and that is the sell signal.
That is an incredibly specific and trackable metric, spending to revenue ratio. I am going to start monitoring that in every earnings call.
And here's the takeaway. We are living through the largest technology investment cycle in human history. $2 trillion in 2026 alone. The technology is real, the products work, and the demand is genuine. But the gap between spending and returns is the widest it has ever been in any technology cycle. Either AI delivers transformative productivity gains within the next 2 to 3 years, or a significant portion of that $2 trillion will be written off. History says that in every major technology investment cycle, the technology eventually delivers, but the early investors mostly lose money because they overpaid. The railroad was transformative, but 90% of railroad stocks went bankrupt. The internet was transformative, but 95% of .com stocks went to zero. AI will be transformative, but betting on the right companies at the right price in the right time frame is what separates investors from speculators.
And I want to add one more thought on SoftBank specifically. Masayoshi-san has made 2 massive concentrated bets in his career. The first was on Alibaba, which turned a $20 million investment into a $170 billion gain. The second was the Vision Fund, which lost $32 billion before partially recovering. Project Izanagi is his third and possibly final major bet. The outcome of this bet will determine not just SoftBank's future, but also whether Japan becomes a major AI infrastructure hub, or whether the country overpaid for a seat at the table.
That is a perfect way to frame it. San's track record is 1 for 2 on transformational bets. Izanagi will determine whether he is the greatest technology investor of his generation or a cautionary tale about hubris and concentration risk. Either way, the next 12 to 18 months will be decisive.
And coming up next, we are looking at the quantum computing race in Asia, Japan's Riken, China's Origin Quantum, and South Korea's massive quantum research budgets. Is quantum the next frontier or the next overhyped technology? We'll break it down.
Thanks everyone for listening.
Stay data-driven.
Bye.